Finally, finally, there's been some good news for the housing market. Good news. Aren't mortgage rates up again? And aren't there like a bunch more articles talking about inflation still being a problem and this is going to crash and that's going to crash and all of that? How in the world can you say that there's good news? Well, sometimes perception plays a lot in how you interpret the events that you're reading. So stick with me for just a few minutes today as I explain. Hi, this is Andrew with the Andrew Smith team here in Frisco, Texas. And good news, I'm not going to say it's a stretch because there is some good news, but perception does play a big part in this. And there are some things emerging. There's some data out there that actually shows there is good news depending upon how you look at it. So first and foremost, FHA loans. That's a big one because FHA are an extremely popular loan program or loan product that people use when buying a home. And one of the biggest benefits of FHA loans is the fact that they allow you to purchase for as little as 3.5% down payment. Now, anytime you're buying a home and putting less than 20% down, you are required to have mortgage insurance premium, known as MIP. What that basically is it's an insurance policy in the event that you default on the loan. And it's an insurance policy for the benefit of the lender that you, the borrower, have to pay for because you're putting less than 20% down. So why do I bring that up? Well, that's actually some of the good news that we've had, really positive news that came out in the last few days. And this is really big because FHA have lowered the mortgage insurance premium percentage down to 0.55%. And that's a big deal because it saves you money. So what does that mean in actual dollars? So for instance, on a $400,000 purchase, your payment's now $98 a month cheaper. Okay, $450,000 purchase, $110 cheaper. A $500,000 purchase, $122 cheaper. Okay, so again, not numbers that are absolutely going to make a tremendous difference overall, but hey, when you consider where mortgage rates are, every little bit helps. So I will say that is most definitely good news. With that in mind, the other thing I just wanted to point out today is with regards to these mortgage rates overall. And mortgage rates have gone up in the last couple of weeks, as you probably know. But I'm going to say that there's actually an element of good news in that. Now, bear with me here. All right. Now, here's the thing. As many of you know, one of the reasons prices have stayed high as long as they have is the fact that demand relative to supply, right, has been out of balance somewhat. Supply remains critically low. And what you may have seen, and what some of the headlines that you may have seen just recently, is that every time we see an uptick in mortgage rates, like we did again in the past week, we get a report that mortgage applications fell. Well, why is that a good thing? Well, if you're in the market to buy a home right now, if mortgage applications fall, that's an indication that future demand has softened. Bottom line, there's going to be less buyers looking to buy a home in the next 30, 45 days than there would have been. When you consider how tight supply is right now, that is a good thing. That actually means there is going to be less competition for you when buying. But Andrew, the mortgage rates are higher. Why would I want to buy now? Mortgage rates aren't going to stay high forever. I've been talking about that, and that's just not my opinion. That's what most of the leading indicator or most of the leading forecasts are actually telling us. And let me tell you why I believe that is the case. So take a look at this graph. This right here is from Freddie Mac, and this actually shows us the spread between the 30-year mortgage rate and the 10-year treasury yield. Now, if you've seen any videos I've done in the past, you may recall that mortgage rates are not directly tied to what the Federal Reserve does when they raise rates. It's tied to the 10-year treasury yield. And over the past 50 years, the average spread between the 10-year treasury yield and the 30-year mortgage rate has been 1.72%. Okay, but that hasn't been the case so far this year. In 2023, we've been running well above that. Okay? And the reason that we've been running well above that is the spread can also be called the fear factor. Whenever there's a great amount of fear or uncertainty in the marketplace, you actually find that the spread between the mortgage rate and the 10-year treasury yield increases. Here's a look at how it has been so far in 2023. See, we started the year at 2.705 and are currently at 2.930. That's an average spread of 2.737%. Now, the spread has never really stayed that high for extended periods of time. It always comes back to that historical yield of 1.72. What that tells me is that as soon as things in the economy start to settle down a little bit more, that you're going to see those mortgage rates start to come back down. And as you might recall, we saw a dramatic drop off in buyer demand when rates hit 7. But when rates got into the low 6s, they dropped below 6.5. We saw buyer demand increase again. We've seen a lot of activity here in Frisco, here in Prosper. The new home builders are busy. There's a lot of people out looking. In some cases, homes are getting multiple offers. Now, that doesn't mean that there's bidding wars, but it's just to show that there's a lot of people out there. Now, the reason I bring this up is here's the good news about what's going on right now. Inventory remains low. Anytime there is a drop in buyer activity, if you're in a position where it makes sense, and it does for some people, it doesn't for everyone, but if it makes sense for you to consider buying, now might be a good time to look, as there's less competition out there for the relatively few homes for sale that we currently have. And based upon the 10-year treasury yield spread between that and the mortgage rate, we know that those rates are going to be coming back down. And many of the lenders out there, including my preferred lending partner, actually have programs in place that once you close on a home, when those rates do come back down, they will offer you a chance to refi at no out-of-pocket costs for you. Again, I'm not trying to convince you one way or another of what you should or shouldn't do. I just want to give you a different perspective in ways to look at things in order for you to make the best decision for you and your family in this time. Hopefully this helps. And if you have any questions whatsoever about different mortgage types of programs or what's going on in the local market, please don't hesitate to reach out. You can always email me at andrew@theandrewsmichteam.com, or feel free to give me a call at 469-296-5230.